My name is Skip Coomber. As we mentioned, I live in San Diego. I am an attorney from way back. I have founded and run two significant family offices over the years. And in fact, in '95, when I started the first one, we didn't even know what a family office was. But I just had a wealthy heiress who needed someone to take her by the hand and lead her through life. So it's been an interesting career thus far. In addition, I've done a number of different investments on my own account. I own a winery. We have a tasting room in downtown Oceanside, San Diego. I served as a trustee on the San Diego County Pension Fund, investment advisory board for the San Diego Foundation, and a number of other things along those lines. So it's been very interesting. I started speaking with Marty, I don't know, 12 years ago, maybe more, up in Los Angeles at a conference he did. I've met a lot of interesting people through the years. Anyway, enough about me. Gentlemen, let's work our way through. Would you like to introduce yourselves? Or Marty, you want to run with this? Marty's not there. He's using the phone.
No, feel free to introduce yourself.
All right. Yep. All right. Alo, do you want to start? Tell us about yourself.
Sure. So I live on Sand Hill Road, where the venture capital industry started from, but it's now kind of thinning out. I started my career as a finance faculty member at the Wharton School, and then I was recruited into McKinsey, helped start their corporate finance center. This was in the way back in the junk bond days, with my customers being Mike Milton and so on. Since then, I started my own fintech consulting company and expanded it to 600 people in countries. Ended up selling it to George Soros's fund.
Wow.
Subsequently, I wanted to change, so I went all the way out in a crazy place, which I won't even name, but headed up a $4 billion VC fund for about 4.5 years. And now I run a small fund, mostly my own money, called AI Labs, and it's basically very early stage AI deals that I closely manage and even mentor the team. So that's where
Alo, before we continue, Alo, you referenced changes in Silicon Valley. I think I missed the actual word, but would you share those thoughts with us?
Yeah, you must have. Most people have probably read in the press about a lot of people leaving the Bay Area because of high cost of, office space and residence, and so that's been happening a lot with the venture capital community as well. So along Sand Hill Road, where I live, it's almost all the big names from Kleiner Perkins to you name it, Lightspeed and whatnot. They have their offices here, but many of them have moved into the city, moved out into other states and so on. So the time I came here 20 years ago till today, I think the number of VCs had grown to about 100 odd big name firms to now about 25 or so.
Oh, really?
Yeah. Yeah, it used to be that you couldn't do a startup in Silicon Valley unless you were 20 miles within the radius of Sand Hill Road, because the VCs didn't want to drive much.
Well, we're hearing about Boston, Austin, other places. You referenced they've gone into the city or other places locally. Have any of them migrated completely out of state?
Yes, number of them have gone to Austin, as you pointed out, including Elon Musk and HP and Oracle. All of those guys have moved to Austin, but that's moving for tax savings. As you know, Austin and Texas don't have any taxes, whereas there are very high taxes in the Bay Area. So other than that, because of the pandemic, a lot of developers have moved online and away from from this area, but nonetheless, Google and Facebook and Netflix and others are still expanding their real estate space. As a matter of fact, Google is now creating a 70,000 person little village, and so is Facebook, about 100,000 new people.
Wow.
So those bubbles will remain, and other than that, the new startups and so on are kind of needing to move out.
Bill, do you want to introduce yourself, please, and tell us about Fernbrook?
Sure. Thanks, Skip. Pleasure to at least be connected with everyone on the panel. And thank you, Marty, for inviting me. Skip, like you, I'm a recovering lawyer as well. I started my career as an accountant at Price Waterhouse back when it was actually called Price Waterhouse. M&A law, and then I became an entrepreneur and started a merchant banking platform with two of my clients from practice of law, where basically we were operating as an investment banking boutique, M&A and corporate finance advisory services, but then investing in our deal flow. We had a group of about 20 investors who helped capitalize the firm alongside our own capital, and they provided, relationship network for deal flow, but then they also co-invested in our deals. So the deals I led generated in excess of 3.5 times invested capital. And, long story short, we built that firm to about 20 people. We sold it to FBR Capital Markets in the middle of the financial crisis. Our investors made a 15% return. They got the cash and we got the stock, which, so the partners didn't do as well as our investors, but I guess that's life. And long story short, a lot of those investors have come back to back me at Fernbrook, my partner and me at Fernbrook, which is great. I met my partner, Mary Gay McKee, who is a retailing executive. She ran Harrods for 16 years. Well, she was at Harrods for 16 years, ran it as the chief merchant officer for the last 6 years of her career. She was part of the team that sold it to the Qatari Investment Authority, and then she was recruited over here to be the president of Saks. So she brings operating experience, understands brands, and also understands the technologies and services that improve the consumer journey. So our mandate at Fernbrook is to invest in early stage venture position companies, both brands and retail and consumer technology, B2B, software and cloud-based services, and we can help sell those those products into our retail and brand, relationship network. So we really can help these companies scale by picking up the phone and getting them, set up for the sales call at the right level of the company. So we're hands-on investors with a lot of, deep experience.
Wow. So you already have the network in place and you have the reputations, presumably. So when you call, and I assume some big box retailers, Costco's, et cetera, when you call, they know you're not going to give them, I presume you're going to refer to them something you really believe in.
Yeah, we can call anywhere. Really, we have relationships with Walmart, Target, Costco, but then on the department store side, look, department stores are stressed, Nordstrom, Macy's, Bloomingdale's, but they're investing in tech because they're trying to reduce their footprint, but they know to get the customers in the store, they've got to engage them and improve the how they're optimizing the journey, and whether that's online on their e-commerce site or in store. So we find that they're actively looking at new technologies to help improve the consumer's journey. And so we can pick up and call the C-suite and get, a company like Lily AI, who's in our Fund 1 portfolio, positioned at the right level instead of having their head of sales sort of trying to claw their way up to, the right person to pitch.
Well,
and
sorry.
Yeah, no, that's it.
So I'm curious. So when we opened we'd been making wine because we invested in a big winemaking facility, and we've been making it since 2008, but we finally opened a wine tasting room a year and a half ago, almost 2 years ago. But I knew from the beginning, it really wasn't about wine. It was about the experience, the guest experience, QX, or the CX, consumer experience.
Yeah.
And as I've been watching the changes with regional malls and some of the big box retailers not making it, obviously competition from Amazon, et cetera, it struck me that these retailers are going to have to create more of an experience for the guests. So there's a reason, the customer, a reason to go in as opposed to just having Amazon deliver it to you that afternoon. And so you're investing in the products and the brands. Does that incorporate this concept I'm referencing?
It does. Yeah, we definitely have two big baskets of our portfolio, typically digitally native brands and better for you concepts in beauty, food and beverage, health and wellness, fitness and outdoors, and sort of those broader categories. Some technical and niche apparel that's really focused on just an underserved, market where we see a big opportunity. But then on the other basket are these retail technology services, right? That are B2B oriented, that, the retailers, whether the big box retailers or more department store or brand, frankly, consumer brands that operate, a network of their own stores and websites, they want to, when they get the customer in the store or on their website, they want to make sure that they're either driving more products through personalization and customization, which is more of, algorithmic, software, or if they're in store, they're using touch screens and other, technologies, hardware and married with software to entertain the customer, right? And give them a deeper knowledge of the product that reduces the number of humans in some cases they need. And then also we're looking at payment services, point of sale and other merchant services that small and large retailers can use. So it's really, across the board of anything that's consumer facing, but that's B2B in nature. And then marketplaces, which are, typically two-sided marketplaces where you've got brands and retailers selling through the marketplace, but they're selling to the end consumer. So
Skip and Bill, I gotta jump in here because Jan Arp just joined. I want to make sure he gets his intro in.
Sure.
And then we can get back to the conversation.
Yep.
So Jan, can you introduce yourself? Talk to us about your accelerator, where you guys operate, and the kind of deal flow you have.
Yeah, absolutely. Thanks for that. Jan's founding managing partner, Holt Accelerator, backed by the fifth generation Holden family office. It's been quite a ride over the last 3 years. We assembled a database of the early seed, everything before Series A, 10,000 fintechs that there are globally. We use data science to sift through and help identify the top fintechs, matching that with now our 400 advisors. So these advisors are financial institutions, family offices, investors, experts, but all that who want to play and invest, adopt, so to speak, early stage fintech technologies. And so through that process, we've actually made about 27 investments to date. We've seen about 50 deals through this whole process through the advisory network that we have. We see a lot in terms of them either adopting these technologies themselves as customers, but also investing. So we've actually, where there's about 50 million in deal flow going through, 30 million closed, and this is early stage. So there's a lot of these deals that are being pushed through, right? So it's early stage. We're seeing finally some Series A investments. It's a great time to be in fintech. There's just been a bit of a surge in it. I mean, overall, I think deal flow is a little bit down for 2020, but hasn't taken that big of a dip. But I could tell you, like, customers, their need to accelerate digital adoption has increased. So for those that can get into the right channels and pivot accordingly, we've definitely seen a surge and an uptake there.
So you were saying you have a database that you assembled of early seed, 10,000 fintechs in early seed. And then you mentioned you're matching them with advisors. So you coming in and mentoring them in addition to investing with them? Is that sort of, you're sort of like one of those places where they go in and they get together and germinate from there. Is that?
Yeah, there's a piece to that. I mean, maybe I'll explain the process, take a breath to explain that a little bit in detail. So we start off with a bit of the big buckets, right? There's 4 buckets to financial services, the way we see it. I earn, I leverage, I'm protected. Within that, there's sub verticals, right? So in there's digital identity, right? It's very hot right now in the fintech space. What is that comprised of? It's comprised of, onboarding. It's comprised of KYC, AML, but there's a big topic around open banking. So it's that person and those credentials and the sharing thereof between players. So once you understand that landscape and the direction the world is going, then you can segment accordingly. You can rank the best companies that you see in that space. You can target them, and then you can actually have them, you have conversations, you get them to apply, so to speak, where we review their business models. We interview them with the help of our financial advisors. So we're also leveraging our financial advisors to review this research. We're picking off the ones who have very interesting beliefs and concepts around it. But then on top of that, who can potentially adopt those technologies, because maybe they're the financial institution who's looking for that solution to fill the gaps. And we saw a lot of that during COVID, right? Digital onboarding, you didn't have a choice. You needed to accelerate that process there. And there's been a surge in fraud. So who you are, right? Well, it's also who you're not. So identifying if that person is who they say they are in this story. So through that process, when you do that match mix, so we also are profiling our advisors every time they're ranking, they're saying, I like or I don't like. It's kind of almost like, a Tinder for fintech. I don't like that term because Tinder has cybersecurity breaches, but you can appreciate the algorithm that goes behind it, right? So we're better able to identify where the areas they do like and where they don't, and they give feedback on that process, which therefore, when we do invest, there is a likelihood there's a network effect, right? There's a base of customers, a base of investors, a base of experts who want to support this company. So it increases the odds that deals actually happen. So that does feed to the next point, not just investments to de-risk, but let's facilitate those intros. Let's figure out what's needed, those hurdles to get over it. And do we have a group of partners around the table to support them? And we facilitate that through weekly meetings. We would be in person in some cases. We're actually based in Montreal, but we do things internationally, and we did shift completely remote, completely digital. Digital deals are still happening. It did slow down. There's still some investors who want to look you in the whites of the eyes before investing. I get that. But there's still others that, we don't have a choice. We need to move forward, and investment still is happening. And, we still need solutions to help with financial institutions.
An incubator, of course, was the word I was searching for there. So you're a pseudo incubator of sorts. Okay. So the obvious subject for us to start off with would probably be the impact of COVID on what we do and how it works. You referenced that a little bit, Jan. Bill or Alla, how's it changed? I mean, obviously with Bill, retail is changing as a result of it.
Mm-hmm. Yeah, for sure. I mean, look, with the pandemic, we saw a dip in the first few months of, sort of deal flow, but, we have a pretty big portfolio. So we saw, the opportunity to invest offensively and defensively in our portfolio just to, extend runway, which was sort of the focus in Q2 and Q3 of the year. And, look, we actually had our first exit on the fund in Q4, and, at a very attractive, return for our investors. So, we've seen, sort of mixed reactions. I mean, our portfolio has been performing pretty well. We have some companies that are just more exposed to stores being open, which is going to be a problem for them, if this continues on past the fall. But all in all, given the incredible pivot of just the growth of e-commerce, and that affects, like what our friend was just saying about, payments and fintech. I mean, just the explosion of e-commerce and online sales. So that's been great for our portfolio. And we saw new deal flow dip, as well, but sort of picking up in Q4. And so far this year, it's been very active because, like every crisis, it's where all the best companies are formed, because people see like the tide goes out and it's like, okay, this is where you want to focus. And so we're seeing some really interesting, tech ideas come out of this on how to address some of this dislocation in the consumer retail world.
If I may.
Yes, please, Ella.
Yeah. Okay. So there are two trends that have come out of the pandemic, and also the amount of dry powder that has accumulated with the VC and PE population. And these are kind of Silicon Valley specific. First one is, of course, you've all read about the popularity of SPAC. So SPACs are, if you've lived long enough, have been around a long time. I encountered them in the 1990s, and then they fell into disrepute, and they've made a comeback in Silicon Valley. And part of the reason is that there's so much capital, and there's so much need for the VC community to, move towards the size of deals that he deals with, that SPAC has come back with a vengeance. And the interesting thing about a SPAC is that it's a very good exit vehicle for the investors, but it is also fraught with risk. The guy who was made SPAC really hot here, the fellow called Amat, won't pronounce his last name. He made his $1 billion from Facebook, and then created a venture capital firm and so on. He's now become very rich. He has brought back SPACs in the Valley and has done many deals. The first one he did was with Virgin Galactic. This is Richard Branson's space travel thing. And when he completed the deal, the shares of the space company went 129% year to date and 440% since the POA offering, the SPAC offering. Another one is Open Door Technologies, which is on-demand digital experience, buy and sell a home. Buying and selling a home, everybody knows, is a multi-trillion-dollar market, and not yet, aimed by technology. So there's a big opportunity there. After he started his SPAC, it's up. Company's up 166% since their IPO went public. So there's a whole range of these, and you're looking at right now. There's about $73 billion odd in these SPAC entities, and so it looks like a bubble in the making, and it is. So what is it that investors need to look out for? Okay, there's a whole bunch of stuff that accountants and tax people will tell you, but one of the most important problems I see is that unlike an IPO prospectus or any other sale prospectus where you can only talk of the past performance, in SPACs and pipes, you really talk about the future. So you can project anything you want, and you can paint if you're a good storyteller, you can paint a picture that will weaken the resolve of a lot of well-seasoned investors. So that's one thing. The other is that there is an incentive for the SPAC originator to let it just fold, because if a SPAC folds, the money that was put in escrow is returned to the investors, but the sponsors still maintain the warrants and the stock options and so on at no cost. And sometimes those things can really shoot up in value. So that's one trend. The other trend, which is kind of not very well known, is democratization of venture capital and private equity using AI. So over the last 5 years or so, AI is now entirely based on data. So VCs have started collecting data on deals all across the world, and a lot of detail. And so all of this has been put together into AI algorithms to
Alo, I'm sorry to interrupt you. I figure if I didn't understand something or comprehend what you said, maybe someone else didn't. Would you start that little bit over there back with the equity using AI? And because I missed something in there, and I want to be able to follow.
There was that blank spot there.
Okay.
Yeah.
Let me hear me. Yeah.
Yeah.
So there has been a lot of data on deals that has been in the, trapped inside VC companies and e-companies, but are now available to people who want to buy them. And so there's a lot of data on hundreds of thousands of deals done in the past and how they have been sourced, due diligence performed, and valuation and so on. So using all this data, um, VCs are now sourcing deals using algorithm. As a matter of fact, McKinsey did a very interesting interview of one of the people in the frontiers of doing
dropping
this.
again.
Oh, okay. So the deal sourcing and due diligence has now become quite automated for a large range of financiers in both VC and PE.
Alo, what are the sources of this data that you're talking about?
Okay, so this data is some of it is publicly available in the deals done before, and also the large VCs and PEs have their own data which they're merging with the public data, and they're anonymizing all this data. They're also sharing it with others because, as we all know, in AI, the more the data, the more valuable the algorithm. And so with the sharing of this data, there is now a critical mass of data that is very interesting in terms of, getting a handle around deal structuring, but most importantly, valuation. And that's where I'm involved. I have a couple of startups on valuation that use AI to look at trends with unstructured data out there and try to figure out what kind of trends will drive the valuation of startups in specific areas of technology, in genome editing to you name it, in fintech particularly. And so that's a very exciting area that in the next 3 to 4 years, this whole area will be, the whole domain will be available to people with relatively little money to invest, even retail investors. So there's, yeah, so I'll stop there, but there's a lot of activity.
With respect to the SPACs, you sort of intimated that a lot of fraud would come to light in the future, because when you reference just being a good storyteller, is that what your implication was, that you expect some fraud out of this?
Yes, like everything, there'll be a big bubble. It's already forming. And because there's so much money floating around, people have estimated about $1.5 trillion in the PE and VC world worldwide. That's dry powder. And so when there's so much money, there's usually a lot of laxity in deal sourcing and so on. So with all this excitement of 100%, 200% returns in today's SPACs, there's going to be a rush of money into these deals, and there's always people who want to who are basically fraudsters. This is what happened in the 1990s. I got into a couple of deals and I realized that it's very easy to defraud people. But nonetheless,
I think I gotta disagree with you here. I think the law on SPACs has changed dramatically. We had a SPAC panel before Silicon Valley Group. The law has changed a lot. The due diligence has changed a lot.
It is.
And you've got your second round of analysis. If anything, SPACs to me are just symptomatic of this great asymmetry that we've created due to the issues of 2001 when the market crashed with tech before, and not enough companies go public. If you look at, there's 400 unicorns outside worldwide right now, and what, 20, 30 companies go public. So everybody's looking for different ways to get liquidity. SPACs are one method. Going public in Australia is another method. There's a lot of different methods out there for doing it. Even then, there's still a huge backlog of companies who want to go public who aren't necessarily unicorns, right? So there's 400 unicorns, but there's probably 1,000 plus half unicorns out there, right? Those companies used to go public all the time in the 90s.
Right. So that, no, I totally agree that this is a great exit route. And I'm sorry if I emphasize more of the negatives than the positive.
Yeah,
I thought
I'm just saying there's a wellspring of great creativity. And what's happened is that companies that used to be able to go public easily,
Huh?
I mean, in the 80s, even by 80s criteria, they would have gone public. You know, Apple would have gone public with $30 million in revenue, right? Now you need billions in revenue to go public in the US. So there's this great a lack of equilibrium in US markets. And so SPACs are just correcting a part of it. And then again, you know, there's other a lot of fintech companies I think want to go public in Australia, I've been told. So,
yes. Australia has a number of them. Fintech has gone through, decade plus of infrastructure building. Most of the companies that came about in the last 10 to 15 years have helped build a huge infrastructure of in fintech. Now the new companies that are coming up are using the infrastructure. As a matter of fact, almost every startup is using fintech infrastructure. So all of that is great, but at the end of the day, what I'm worried about with SPAC is that if you've seen the prospectuses and so on, there's so many stories being told. There's no way to verify for even a well-heeled investor as to how encashable those stories are. So that the other trend that I don't know if you were around, Marty, when I was talking about it, is the fact that AI is helping deal sourcing become accessible to almost anybody. So
sure, yeah, absolutely. And my question is, so what you were talking about was like, what's the role of AI and how much private data do these very large venture capital and private equity firms have that isn't publicly available? But my question is, you know, at what point is there convergence between the availability of public data and statistics versus what AI infers, right? I mean, to me, there's all kinds of issues with especially when you're funding something at the seed or pre-seed round, right? You're talking about the team, the players, the mentors, the partnerships, you know. Again, we talk to a lot of ventures. It always amazes me how there isn't a marketplace for venture capital like there is for credit, right? There's like, as we know, we went through these credit marketplaces back in the 2010s, let's say, Prosper, et cetera. And I don't know why there's not, I mean, we have Angel List and things like that, and you've got crowdfunding, but to me, there should be venture marketplaces. Because I don't see the high differentiating factors of venture capitalists these days. It seems to me that if you want to go on LinkedIn and find partners for your startup, you can do that pretty easily without a venture capitalist helping you.
Yeah, so
Start at the top.
Venture marketplaces were lacking the technology to figure out more information and analysis.
But you're saying that's available now.
It's available now. There's a lot of research that was done on data collected in business schools around the world, particularly in Europe and as well as here. And the VCs have shared their data because the more the data, the more useful the analysis. And so everybody understands that here. So keeping the data in a silo doesn't help anybody. And so the data sharing has come about. And, you'll be surprised as to how much data is available on teams, on early seed startup and technologies. And you know about ARK Invest, right? Everybody knows
Yes.
everybody knows about them. Another company that's using this kind of data quite well. And so there are examples of other funds coming up, ETFs, that'll base themselves on startups and new technology and so on. That's a very interesting field.
That's fascinating. Yeah.
We just, can I chime in on some of this stuff, just because we were studying ways of kind of building the data science approach to investing. And so very much, I think it's only really taken shape in the last 5 years. Part of it is technology. Part of it was an unwillingness of the venture capital side to actually adopt the technology, not practice what they preach as well. There have definitely been some front runners, avant-garde, who are phenomenal in the space, who trailblazers, but I still think it's about 10% of all VC funds. But okay, what is AI and what is the data? At the end of the day, a VC's, you can break it down into, I've seen people break it down to 11 steps. We broke it down into 6 steps, but let's like talk about some of it. One of which was the marketing and origination to the due diligence and negotiation, right? So I kind of bundled together a bunch of stuff there, and that's where the data comes into play. So there are tons of sources, right? We've mentioned some, you know, you have your angel list, you have tractions, you have pitch books. They all tell a different side of the story, and they have their own ranking systems and they built their own engines. And like increasingly there's more and more. There is also a bunch of suite of pitch contests that are occurring with platforms dedicated for that. And for those who like ourselves, we end up being judges all the time, so we can see the insights and get, you know, sift, process the data, augment, add value to it, so we better assess it as it goes through. We have our own database. Well, we have 2,500 applications that we reviewed. So we don't share all the data with all our partners because we're that, you know, we also believe that's part of it, is assessing it, our understanding, our interpretation of that data. And yes, we look at the world through 4 lenses, key buckets. Team, absolutely. We're applying psychometrics to assess the founders. Yeah, you can also pull into LinkedIn and track the track records and all that fun stuff and scrape that information to better complement it. But you can that's just team. You can apply this through product, financing, and market, and their ability to market, to go to market, how big is the market, and how good that customers are. So all that stuff, like there is tons more to build already. I think we're still in the early days, and there's a bunch of research that's public about a bunch of companies already doing different things. Some are further advanced than others, absolutely, because it's definitely a way to sell the fund and use the buzzwords, and some are definitely crushing it.
So just my one comment is, I'll use an analogy of chess. So as we know, when the AI started beating humans in chess, humans started using more AI to practice, and now there's more grandmasters in the world than ever before, right? But actually the AI that's on your everyday cell phone chess is pretty good. And so people who are not good, who are mediocre at chess, can play it over and over again, and they actually get better too. So I know somebody who's an educator he runs a chess club for 8th graders, and he routinely brings, you know, he doubles their score in chess. So, but I want to talk about one more problem, and we've got about 10 minutes, but I want to talk about one more problem, which is kind of applicable to Bill Detwiller and Skip. So one of the companies that's approached us in the past is a wine fund, a wine company, right? So they've got a rating system, and I think it's applicable to retail, which is that there's something like 150,000 types of wine in the US, but only about 1,000 of them stock 95% of the store shelves in the country, right? People can't find out about them. And then when you look at the rest of the world, there's maybe 400,000 wine labels. I mean, you have to go to Italy, find a great place. It's sunny day, you're sitting on a bench, you're having some cheese and wine, and it's really great, but you can't find that wine in the United States ever, right? So what they've done is they've actually created a database of every wine, and now they're measuring against every pallet, et cetera. And is that really the retail problem? Like, so when I was in undergrad, it was like a big deal that here you are, Ivy League school, you go into the stacks and there's books that nobody's ever seen that you have to find and study from. But now all those books are on the internet. They've all been scanned, et cetera. So now it's a matter of making that information more valuable. So with retail, like if you go into the stacks of Macy's, there's, as you can tell, there's piles and piles of crap that nobody's ever going to buy, but you have to find out the one that's good for you. And maybe that's like the big retail problem, is finding, you know, selecting the items that are good for you. And that's the same thing with wine as well. And Bill, I was hoping that maybe you could address that whole, you know, they call it personalization, but it's actually more than that, right?
Well, it's really like, it's, you know, it's not as much, you know, people I think use artificial intelligence. This is more machine learning, right? Where you're just getting your hands around huge data sets and mining it for really what people want. They don't want, you know, the option to pick from, you know, 150 different colors of t-shirts. 90% of your sales are going to come from like I'm making it up, 3 colors. It's the same thing, and that's the power of like any marketplace. Your analogy of this wine idea, I mean, that democratizes, you know, wine, and gives a person a marketplace. Like, I want something from like some little, you know, town in Italy, some wine, and then I'm sure these guys can then say pinpoint 5 varietals of that red wine, and then it's at your fingertips, and then you have to figure out how you
every
get
palette
shipped.
is different, right? That's the point, right?
Right. And, you know, and you can optimize it. And again, the machine learns. You can say, I like dry red, you know, that's harvested in the month of June on the 3rd day of the 2nd week, whatever it is. And then, you learn from all of that data sets, and then you can make the power of it is making the recommendations and the customization to the end consumer. And what that does, and this isn't in the wine, but this is like more of, in the retail environment, if you can drive product recommendations to a consumer, you increase the basket size, right? So you increase your revenue, and then arguably, and this is what most of these, what we see, they reduce returns, which all of that hits the bottom line. You grow you increase the basket size, and you reduce the returns, and then
Reduce
you've
operational cost. Got it. Yes.
Yeah.
Right. So I know somebody who buys lots of shoes. I won't name her or say that she lives with me, but what I will tell you is that she orders 3 sizes in 3 different colors because there's no uniformity in shoe sizes, right? So, and there's a lot of returns because she keeps,
Well, fit, like
that's
that's like the last mile. I mean, not like the shipping end of it, but getting the fit right, which is, I think, harder for shoes, but in apparel and wardrobe, the technology is just getting better and better and better, that you can take a photo of yourself or have your wife or whomever take a photo of you in a t-shirt and, shorts or whatever. And then that can read, shoes are probably different. I don't know what technology they have for feet, but all of that technology is really for in-store and at home uses, changing the game for retail. Because the returns are the biggest pain point.
We've got about 5 minutes, guys, max.
Maybe I just want to touch on one real quick thing on the idea of fit. Like that concept applies also to how we make the investment. So on the other side, you have managed relationships. We have 400 of them. We have financial institutions. They can say, oh, we like this. We're looking for this type of fintech. It's not until we start putting in front of them some fintechs that address their problems that they start seeing that some will rank them very high, some will rank them very low. And they're like, okay, you guys aren't even aligned on your side. It's not until we start moving through the gates and we understand all the departments that we can actually see a better fit, like they can actually adopt this technology. So as you mentioned, that last mile, that's where the crux of the problem is. That's where it's super. So you're looking, it's almost where I see the world, 2 moving targets. Yes, you need to know the best fintechs, but not and rank them, but that's not necessarily the best fintechs are best suited for every fintech or every financial institution out there, right? It's about that match and understanding that fit. And so understanding their problems and locking in that moving target to make, and that changes yearly, right? Like their size, they grow or they change it, like their foot size as a comparison back to the feet, I think. But I just find that same principle concept applies across a suite of other things that we're seeing in the space.
Sure. People have different usages for credit and different trust networks, et cetera. So yeah, Jane, you're absolutely right on that. So, although one of the aspects is that you want to use whatever financial product you can mass market, right? So,
yeah. Quick point about what I've seen on AI is that almost all the innovative stuff is coming from China. The second thing is that, what was it?
Innovations coming from China. And what else?
The second point was that AI, algorithms are open source. You can get the very latest, stuff from China or from Silicon Valley. These are the 2 sources of AI today, of machine learning. And both are available on open source. So there is no intellectual property there. The other thing is data itself, which used to be the crown jewels, is also becoming a commodity. It's available for purchase. So interestingly, what is AI going to give us by way of value?
Locking up in California.
Sorry?
People in California are locking up. I think the bandwidth, you have to get rid of the governor. And that must be the problem because your bandwidth is
please,
terrible.
he's a great guy. Don't get rid of him.
but you and Alan Snyder have locked up constantly. Great. So my only question is, so getting back to like DeFi, and I like to think of like DeFi venture capital, because it seems to me that the stuff that Google and Twitter and Facebook does is antiquated and old, yet they still have monopolies. So I'm not sure how you decentralize that, but it seems that there's something that's off about that they're still so dominant when their technology isn't that fantastic. So
No, Marty, that's not quite true because these guys have been absorbing thousands and thousands of startups. You'd be surprised. I think the number of startups between Amazon, Google, and Facebook that they've acquired in the last decade is over 100,000.
right, yeah. So that gets
So,
back
so
to this
that's
whole
that's how.
gets back to this whole imbalance in the marketplace, right?
No,
That
but
those
that
companies
is for the
would have gone
invest.
public in the past, but instead they had to exit via getting acquired by a behemoth, a
Yeah,
gargantuan
but the
company.
technology is still being utilized by society. Investors are not making the money that they should could have.
Right, right. I mean, to me, in the old days, there would have been a challenger. It would have been funded. It would have gone public, and Google would have faded away. Facebook would have faded away, et cetera. But that's besides the point. Listen, great panel. I want to get to this custom tax deferred real estate panel for family office clients. We've got about 35 minutes for them to speak. So, are you guys there? First of all, fantastic. Thanks so much. I'm sorry I didn't get enough Boston participation on the venture capital panel. We reached out to several Boston VCs, but didn't get any feedback. So, but thanks again so much. And
Thanks, Marty.
Skip it and enjoy California and the tennis. It's terrible.
Thanks.
At
Thanks,
least,
everybody.
at least you have your electric grid. We've had 20 cancellations from Texas who are going to be here.
Marty,
It's
one last
gonna be really cold.
One last comment, if I may, Marty, with respect to your question about the analysis of people's personal tastes and access to
Yes.
wine. Sometime we should speak because wine's really not the right. It's not analogous to what Bill does because it's such a controlled world right now.
Yeah.
What may be great about that is the last hope for smaller wineries, not Constellation, Gallo, etc. We've got five wineries, companies that have 80% of bottles in retail outlets. The opportunity is direct to consumer, right? DTC stuff.
Right.
And we had one of our brands in 1,200, all the Publix markets. And they sold pretty well, but they didn't reorder because the big players come in and they bring in a similar product next to it. They have a better price. They are better at marketing.
Yep.
And remember, the wine distribution in this country is controlled by a couple of big players now. They used to take, and then I'll be done. They used to look for a margin of 20%. Now the big distributors are getting and commanding 30% margins on things that they carry because of the consolidation. There are states in this country where if one of 3 distributors won't carry your product, you cannot sell it in that state.
My only comment is for all the many wine connoisseurs we have in the audience and beyond is that the largest distributor or retailer of wine in the US is Costco. So I don't think they're really setting any taste standards. But anyway, but I love the idea of democratizing wine and democratizing branding, et cetera. So why don't we get